U.S. financial markets have been quite volatile recently after the near-simultaneous collapse of Silicon Valley Bank, Silvergate Bank, and Signature Bank challenged confidence in the financial system. The turmoil has sent shockwaves across the banking industry and caused the stock prices of European banks to plummet. The biggest victim so far was Credit Suisse. The second-largest Swiss banking group has secured an emergency loan from the country's central bank after its shares fell continuously. Experts have blamed the U.S. Federal Reserve's continued aggressive interest rate hikes for the upheaval, putting the world financial market at risk without proper supervision of its own financial system.
Both the Fed and the ECB underestimated the resurge of inflation. They started to react to the increase of inflation above the 2% objective with 6 to 8 months of delay. They should have continued to increase the interest rates, but taking a calmer approach, a more gradual approach.
I would blame it more on banking policymakers and people that are overseeing the banking sector in general. I do believe that there will be, more fallout, and the bank regulators sort of missed what's going on.
As the Fed raises interest rates, that will lessen demand, and that certainly does help in terms of the fight against inflation, but it certainly has other consequences. You have a single bank that has very specific problems, but that's affecting other banks. The consequence of losing a regional player, the potential for losing more regional players, would have a very negative impact on the U.S. economy. And that therefore would certainly also have an effect on the global economy. At the same time, the situation in the European banking is also creating further tensions. It is a global economy, and these localized events can have far wider repercussions. I think there needs to be some more oversight, better regulation that potentially could have prevented this situation from occurring.